Welcome back to ProTicker Podcast, your Tuesday edition covering all the major financial magazine headlines. Today we're navigating a global landscape brimming with uncertainty, from China's strategic market plays to HSBC's dramatic reshuffling and the UK's economic tightrope walk. Get ready for a deep dive into the forces shaping the financial world.
What's captivating today is how these seemingly disparate events, from IPOs to interest rates to geopolitical shifts, are all pieces of the same intricate puzzle. Understanding these connections is key for any investor right now.
Okay, let's unpack this puzzle, starting with a power move out of China that caught my eye in Bloomberg. It seems a unit of their sovereign wealth fund, Central Huijin Investment Ltd., has been quietly shaking things up in the bond market. They've issued a jaw-dropping $29 billion in local bonds this year, the highest since 2010. Now, that's a lot of yuan, even for China. So what's the strategy here?
It's a strategic move, indeed. See, when a government entity like this issues bonds, it essentially pulls money out of circulation. Now, Bloomberg's analysts suggest that China might be gearing up to use these funds to buy up equities in their stock market. Why? Because injecting this money back into the market, particularly by buying stocks, can create demand and potentially boost prices, stabilizing a volatile market.
So it's like a financial pressure valve. They release pressure by pulling money out through bonds and then strategically inject it back in to stabilize things.
Precisely. And this tactic aligns with China's broader efforts to stimulate its economy, which has been facing headwinds lately. Think of it as a carefully calculated move to maintain confidence and encourage growth in the face of global economic uncertainty. It'll be interesting to see how this strategy plays out.
Absolutely. Speaking of navigating tricky geopolitical situations, our next stop takes us to Europe, where banking giant HSBC is making headlines with a major restructuring, as reported by Yahoo Finance.
This is a prime example of how geopolitical tensions can have a direct impact on corporate strategy. HSBC's decision to split its business into Eastern and Western divisions is a direct response to the growing divide between China and the West.
It's a pretty bold move, wouldn't you say? Yahoo Finance points out that this decision comes after years of pressure from investors and scrutiny over their operations in Hong Kong. Some investors have argued for years that separating the Eastern and Western operations would unlock value, especially given the geopolitical realities. Looks like HSBC finally decided to heed those calls.
It's a decisive move by HSBC's new CEO, George Al-Hidari, who stepped into the role in July. This is a defining moment for his leadership as he steers the bank through these turbulent geopolitical waters.
And the stakes are high. This restructuring will have significant implications for HSBC's global operations, its investors, and the broader financial landscape. Now, across the English Channel, another economy is grappling with its own set of challenges, as Yahoo Finance highlights. It seems the UK is facing some serious borrowing blues.
Indeed. Government borrowing in the UK reached a staggering $16.6 billion in September, the third highest September figure on record. To put that in perspective, public sector debt is edging closer to a daunting 100% of GDP.
For those of us who need a refresher, what does that percentage actually mean for everyday people like our listeners?
In essence, it means that the UK government owes almost as much as the entire country produces in a year. This level of debt, while manageable in the short term, can lead to serious economic consequences down the line. Think higher interest rates, reduced government spending, and slower economic growth, ultimately impacting everyone.
So Chancellor Rachel Reeves has a tough job ahead of her with the upcoming autumn budget.
Absolutely. She's walking a tightrope, balancing the need to support a struggling economy with the very real threat of runaway debt. The decisions made in this budget will have long-term implications for the UK's financial health.
It's a delicate balancing act for sure. Now let's shift gears from government finances to the world of IPOs, where two recent market debuts offer a fascinating contrast, as reported by Bloomberg. First up, we have Hyundai Motor India, making a splash with India's largest ever IPO. They raked in a cool $3.3 billion, but here's the twist. Their shares actually dipped on their first day of trading. What's behind this unexpected turn of events?
It's a classic case of investor caution, even amidst the excitement of a record-breaking IPO. Despite the sheer size of the offering, Bloomberg analysts suggest that some investors might be hesitant about Hyundai Motor India's short-term growth prospects. There are concerns about a potential lull in new vehicle launches and increased royalty payments to the parent company, both of which could impact earnings.
So it's like that feeling when you buy something online and it doesn't quite live up to the hype when it arrives. Even with the big flashy debut, investors are still doing their due diligence and looking beyond the initial excitement.
Exactly. And this cautious sentiment highlights a broader trend in the market. investors are becoming more discerning, prioritizing long-term value and growth potential over the initial buzz of a high-profile IPO.
Speaking of prioritizing value, our next IPO story takes us to a very different part of the world, and a company riding high on investor enthusiasm. According to the Wall Street Journal, German software giant SAP has just dethroned ASML as Europe's most valuable tech company, with its market value soaring by an impressive $26 billion. What's fueling SAP's remarkable rise?
Their strategic focus on AI has struck a chord with investors. SAP has been very public about its commitment to integrating AI across its product line, and the market is clearly rewarding this forward-thinking approach. Their recent performance and this surge in market value send a clear message. Businesses that effectively leverage AI are capturing both market share and investor confidence.
It's like SAP has cracked the code to the AI gold rush, and everyone wants a piece of the action. Their CEO, Christian Klein, has been practically shouting about their AI strategy from the rooftops, and it seems investors are listening.
They are indeed. SAP's success underscores a crucial point for anyone watching the markets. AI is not just a passing fad, it's a transformative force reshaping industries and driving investment decisions.
And those who embrace it early on stand to reap significant rewards. Now let's turn our attention back to the U.S. economy, where analysts are buzzing about a potential no-landing scenario, as reported by the Wall Street Journal. I'll admit, this term always throws me for a loop. Can you break it down for us?
Of course. Imagine an airplane landing smoothly on a runway. That's a soft landing, a controlled slowdown in economic growth without a recession. A hard landing is the opposite, a sudden, jarring recession. Now, a no-landing scenario is like the plane just keeps cruising at a steady altitude. It's a scenario where inflation eases without triggering a recession, and the economy continues to grow, defying the traditional boom and bust cycle.
So, no dramatic dips, no sudden crashes, just smooth sailing. Sounds almost too good to be true.
It's certainly an optimistic outlook, and some might say it's overly optimistic. The Federal Reserve is trying to thread the needle, raising interest rates to tame inflation without pushing the economy into recession.
And what does this potential no-landing scenario mean for investors, especially with UBS predicting the S&P 500 could climb to 6,600 points next year?
It could fuel further market optimism. If investors believe the economy can continue to grow without a recession, they might be more inclined to invest, potentially driving up stock prices. However, it's crucial to remember that economic forecasts are not guarantees. There are always risks and uncertainties to consider.
Right, like unexpected global events or unforeseen economic shocks, things that can throw even the most well-crafted predictions off course.
Precisely. Prudent investors always balance optimism with a healthy dose of caution, carefully considering the potential risks alongside the potential rewards.
Speaking of risks and rewards, our next story takes us to the world of private credit, where some big players in Australia are seeing opportunity amidst the uncertainty, according to Bloomberg.
That's right. Bloomberg reports that Australian institutional investors, those managing large pools of money like pension funds, are increasingly turning to private debt as interest rates rise.
Okay, so for those of us who aren't financial whizzes, remind us what private credit actually is and why it's attractive in this current environment.
Essentially, private credit involves lending money to companies outside of traditional bank loans. Think of it as providing financing directly to businesses, often with higher interest rates than you'd find in public markets. Now, as interest rates have risen, so have the potential returns on private credit investments, making them attractive to investors seeking higher yields in a volatile market.
It's like everyone's trying to squeeze out as much return as possible, even if it means venturing into slightly less conventional investment territory.
Precisely. And there's an added layer to this story. Bloomberg notes that Australian banks are becoming more risk-averse, especially when it comes to lending to certain sectors, like commercial real estate, which has been facing headwinds. This pullback from traditional lenders creates an opening for private credit funds to step in and provide financing, often at higher rates, of course.
So it's a classic case of supply and demand. As banks reduce their lending in certain areas, the demand for alternative financing sources, like private credit, increases, creating opportunities for those willing to take on a bit more risk.
Exactly. But it's crucial to remember that private credit, while potentially lucrative, comes with its own set of risks. It's generally considered a less liquid asset class compared to, say, publicly traded stocks, meaning it can be harder to sell off those investments quickly if needed.
So while those higher potential returns might be tempting, especially in a volatile market, it's crucial to understand the nuances of private credit and the associated risks before diving in.
Absolutely. It's not an investment strategy for the faint of heart, But for those with the right risk tolerance and understanding, it can potentially offer attractive returns.
Speaking of understanding risks and navigating complex financial waters, the Wall Street Journal has sparked a fascinating debate about access to private markets. It seems there's a growing discussion about whether these opportunities should be open to more than just the ultra-wealthy. What are your thoughts on this?
It's a complex issue with valid arguments on both sides. Currently, access to private equity, venture capital, and other private investments is largely restricted to accredited investors, those meeting certain income or net worth requirements.
Right, the idea being that these are sophisticated investors who can afford to take on greater risk and understand the complexities of these markets. But the argument for opening up access is intriguing. It could potentially create more opportunities for everyday investors to build wealth and participate in exciting, growing companies.
Yeah. Exactly. Proponents of expanding access argue that investing in, say, a promising local startup shouldn't be limited to those with $1 million portfolio. They believe that with the right education, safeguards, and perhaps even new regulatory structures, more individuals could benefit from these potentially lucrative investments.
But of course, there are concerns about opening up these markets too widely, too quickly.
Absolutely. Opponents worry that less experienced investors, enticed by the allure of high returns, might not fully grasp the risks involved in private market investments. They argue that the current system, while imperfect, provides some level of protection for those who might be more vulnerable to risky investment schemes or lack the financial resources to weather market downturns.
It's a tough one. On the one hand, democratizing access to these potentially lucrative investment opportunities is a compelling idea. On the other hand, protecting individuals from financial harm, especially in already volatile markets, is crucial. Finding that right balance, that sweet spot between opportunity and protection, seems to be the crux of the issue.
Precisely. And that's where regulation and education come into play. The article mentioned an intriguing proposal, requiring investors to pass a financial literacy test to gain access to private markets. What are your thoughts on that?
It's a fascinating idea. Instead of just a wealth test, it would be a knowledge test. If you can demonstrate a certain level of financial literacy regardless of your net worth, you could potentially access these markets.
It's a novel approach, and it gets to the heart of the matter, ensuring that investors, regardless of their background, have a fundamental understanding of the risks and potential rewards before investing in private markets.
It'll be fascinating to see if this idea gains traction. Now, let's shift gears from the world of finance to the battle for mobile chip supremacy. Barron's reports that Qualcomm is taking on Apple head-on with its latest chip release, particularly in the realm of artificial intelligence.
This is a significant development because it signals a potential shift in the balance of power in the mobile chip market. Qualcomm's new Snapdragon 8 Elite chip is making waves with its claim of being the most powerful mobile processor for AI applications, directly challenging Apple's dominance in this area.
It's like watching a high-stakes chess match, with Qualcomm making a bold move to outmaneuver Apple in the rapidly evolving world of mobile technology. Isn't Apple usually ahead of the curve when it comes to this stuff?
They have been, but Qualcomm is clearly looking to close that gap, and they're not alone. They've partnered with some major players in the smartphone market, including Samsung, Honor, OnePlus, and Xiaomi, all of who are expected to incorporate this new chip into their upcoming devices.
So this could be a turning point. With Qualcomm's aggressive move potentially shaking up the mobile landscape, it'll be fascinating to see how Apple responds.
Indeed. Apple has a history of innovation and a loyal customer base, so they're not likely to cede ground easily. This competition will likely lead to even more advanced and powerful mobile devices for consumers, which is always a win.
Absolutely. And speaking of Apple, it seems their iPhone 16 launch might not be going quite as swimmingly as planned. Barron's reports that Verizon, one of the major mobile carriers, just released their earnings, and there are some whispers of concern about a potential slowdown in iPhone upgrades. What's the story there?
It appears the excitement surrounding the iPhone 16 might be a bit more subdued compared to previous launches. One theory is that the newer iPhones are so well built and feature-packed that people are holding onto their current devices longer, delaying their upgrades.
That makes sense. Why rush to upgrade if your current phone still does everything you need it to do? But could this trend of delayed upgrades have a ripple effect on companies like Verizon, who rely on those upgrade cycles to boost their revenue?
Absolutely. Verizon's earnings report showed a decline in revenue from wireless equipment sales in the third quarter, suggesting that people aren't upgrading their phones as frequently as they used to.
Interesting. So how does this all tie into Verizon's recent acquisitions, like the Frontier Communications deal?
Well, it seems Verizon is anticipating this potential shift in revenue streams. Their recent acquisitions, including the $20 billion Frontier deal and the $1 billion spectrum grab from U.S. Cellular, suggest they're diversifying their portfolio and preparing for a future where growth might come from different avenues, such as expanding their network infrastructure and offering new services beyond traditional mobile plans.
It's like they're playing 3D chess while everyone else is stuck on checkers, huh?
Yeah.
They're not just reacting to the current market, they're anticipating future trends and positioning themselves accordingly. Smart move.
Absolutely. And it highlights a key takeaway for investors in any industry. Adaptability is crucial. Companies that can anticipate change, innovate, and pivot their strategies will be the ones that thrive in the long run.
It's all about staying ahead of the curve, right? Speaking of which, let's swing back to SAP for a moment, a company that's certainly demonstrating its ability to do just that. The Wall Street Journal is reporting that they've officially dethroned ASML as Europe's most valuable tech company. Their market value has surged a whopping $26 billion, thanks in large part to, you guessed it, their strategic focus on AI.
It's a remarkable accomplishment and a testament to their commitment to integrating AI across their operations. The surge in valuation speaks volumes about investor confidence in SAP's vision and its ability to deliver on its promises.
They're not just talking the talk, they're walking the walk. And investors are taking notice. Their cloud business is flourishing, they're consistently exceeding earnings expectations, and their CEO, Christian Klein, is a vocal advocate for the transformative power of AI. They're firing on all cylinders.
They are indeed. And their success story underscores a crucial point for investors. Don't underestimate the transformative potential of AI. It's not just hype, it's the future. And companies that embrace it strategically stand to reap substantial rewards.
It's like we've been saying throughout this deep dive. It's a fast-paced, ever-evolving landscape out there. From China's strategic market maneuvers to HSBC's dramatic restructuring, the UK's Economic Balancing Act, the rise of private credit, and the battle for mobile chip supremacy, the one constant is change. But as we've seen, amidst the uncertainty, there are always opportunities for those who stay informed, adapt quickly, and keep their eyes on the horizon. Any final thoughts before we wrap up?
I think that sums it up perfectly. Stay agile, stay informed, and never stop learning, because in the world of finance, the only certainty is that things will continue to change.
Words to live by. And on that note, we'll conclude this deep dive into the financial headlines. We'll see you all tomorrow morning with new headlines from the major financial magazines.